We're going to be talking about insights into the private equity, into the DACH region. Try not to talk too much about Germany since we're in Switzerland. But to help go through us with that today, we've got Giovanna, who's a partner with Altor. It's a mid-market buyout fund working with a 3 billion fund at the moment. And then at the far end of the stage, we've got Christian, managing partner with Renaissance, which works under a little bit more of an evergreen structure. So we've got kind of both sides of the table with us here today. I want to start off by setting the scene a little bit. I've chosen to kind of narrow down on deal count rather than deal value here, but I think this slide is quite important. We've just entered the 10th month of the year, and you can see we still have a little bit of a way to go in terms of total number of exits. So unless we see a lot more announced in the next 2 months, then we might not reach 2023 levels. We actually just launched a couple of weeks ago on Mergermarket, a fantastic new auctions platform that tracks the live market. And when I checked it last night, we had kind of nearly 40 sponsor-backed companies in play in the region, all the way from kind of the beauty parade up to the exclusivity period. Clearly, not all of these will get done. We know we're working in a period of kind of much longer launch times, kind of when the mandate is awarded. So not all of those will get done next year, but we might, hopefully, will at least reach 2020 levels, which is still not great. So let's start off with you, Giovanna, because you're working under the fund structures. So and you just closed a new fund in January this year. I think you've made 6 exits in the year to date, but I just want to know from you, are exits important at the moment, or are you more focused on deployment?
Yeah, so both is important to us, right? So we raised a new fund, 3 billion, beginning of the year, and those are investors that want us to see deploy their capital. So we invested around 50% of the fund already, so we've been very active in investing in the mid-market. But exits are equally important to us. So 6 exits within kind of the first part of the year shows that we really focus on it. And in fundraising and for our investors, DPI is increasingly important. So exit remains a focus, and we're very structured about how we go about exits. And we have a kind of long tail and pipeline of exits to come over the next 6 to 12 months. So maybe we can help bring up that pipeline.
And how are you actually preparing companies for exit in this environment?
Yeah, so we think kind of from the end, right? When we invest in a company, we think, who are we going to sell this business to? What will be important for those parties, and we continue to have dialogues with potential buyers. So that's one part. And then we really kind of, look in something like a data cube, right? Kind of what data will be required on exit, and then what's important around growth, around margin, around kind of the quality of the management team, the quality of the systems, the M&A pipeline. So really kind of the full spectrum of value creation levers that need to be visible and transparent for the time of exit. And then we have a long-term mandate. So sometimes it takes, 3 years only until we exit a company, and it can, last up to 10 years if there's more value creation to be done before we think it's the right time to sell the business.
I'm interested in the data aspect that you mentioned. I think one part when it comes to selling companies that has become increasingly important on all sides of the table is the EBITDA and the adjustment. So are you really making sure by the time you come to launch, you've got full confidence in the numbers, you're keeping the adjustments to a minimum, which kind of helps keep the lenders on board a little bit as well?
Yes, of course. And I think, the due diligence processes are very stringent by the potential buyers, right? So we have an understanding of what the real kind of EBITDA will be that buyers will look at.
Yeah, I was speaking to a lender last week. He said kind of he's now naturally capping adjustments at 5%, whereas I think in past markets a bit 25% was quite often accepted. So I think that's quite important going forward. Christian, I want to bring you in here. I can barely see you down there. Evergreen model. So do exits actually matter as much to the way that you operate?
Well, by the definition of an evergreen model, exit are basically, we don't look for exit. In case we do, it's more defensive, but we keep our company on a yearly, for forever. We have an open-end fund. So from that perspective, we don't have any pressure to look for exits. And we usually buy directly from the family owner. So there's not, we don't buy from other private equity secondary markets from that perspective. But in terms of the statistic here, I think from our perspective, there's two reasons why maybe the statistics are low this year. One is really related to the companies. We see companies, at least in our portfolio, having done extremely well, except even in COVID time, because we were not in the gastronomy or the hotel industry. 21, 22, 23 were very good years. 24 there's a lot of volatility. 24 will still remain for many companies, I think, a very good year, but the ordering book is clearly lower in certain sectors. And I think the question is, when you want to sell a company, do you sell it as a seller, you will take the last 4 years, which have been very good in general, except if you were in certain sectors that were highly, touched by the COVID. And as a buyer, you see this insecurity of 24 still being a good one, but ordering book being lower. And so where you bridge the gap, I think that's one reason. And maybe another part, which is maybe more fundamental, is you have this continuation fund. Maybe the shareholding of companies becoming more stable. We have an evergreen, so we can own it forever. The question maybe also is, we have a lot of family office also coming into the Swiss market. They tend to be longer owner of the companies. So maybe fundamentally there is maybe less of this swapping companies every 4 or 5 years, because the ownership of the company may fundamentally, stay longer, and therefore the amount of transactions would maybe diminish.
I'm going to talk about continuation funds in a second, but I just want to narrow down on something that was discussed in the previous panel on valuations, which I also think helps explain this data, because 2023, everyone was kind of expecting valuations and kind of entry multiples in terms of EBITDA to drop a little bit. But I think 2023, we saw the best assets sell. And so as we've entered 24, it's kind of the less is maybe not the right word, but the not as good quality assets come to market. And now we have started to see valuations drop off a little bit. Is this something that you've witnessed, Giovanna?
Yeah, so there is a point around 2023, and 2024, we see a lot of companies coming to the market, and, a lot of exits just don't happen.
Yeah.
And in 2023, there was maybe less instability, kind of what we heard earlier from Florian around kind of macroeconomic stability, political instability, geopolitical instability. It was less maybe prominent in 2023 than it's in 2024, or more clear that it's, to stay. And that has an impact on what, we and others are willing to pay for assets. And that continues to kind of drive that overhang in exit to be realized.
Do you want to talk through perhaps what has been your best exit this year, if you're able to?
Many, but I think the most exciting one has been the sale of Silo AI, which is Europe's largest AI consulting business. 250 PhDs out of Finland, which we sold to AMD, and that was a great exit for us.
I think I know kind of we're everyone on this stage is operating in the kind of small and mid-cap level, but you do sell, hopefully, into the larger size bracket. And I think just in terms of exits, because we actually saw on Monday Europe's biggest private equity exit in the year to date, which is when Partners Group sold Techem to DPG for 6.7 billion. And the fact that was overtaken, I think the largest before that was back in March with Altor and Cinven at 5 billion. So large cap is coming back. But are you seeing much appetite in terms of exits from the large cap players to buy your assets?
Yeah, so on the larger end, we see that. So I think once our businesses reach $1 billion plus, then you see large cap interest. And they often reach out proactively. They need to deploy capital. They're very professional and proactive around their go about business. So there we see interest in active dialogues.
Okay, great. And continuation funds, because obviously this graph isn't the whole entire picture of how GPs are actually returning capital at the moment. So just a couple of examples of continuation funds. We've seen a few in the region in the past couple of years. Ufanel Capital closed a GP-led secondary for 2 of its portfolio companies, Corius and Altano, in 2022. And in Germany, more recently, we saw Greenpeace raise a vehicle to hold two of its assets, Academia and Sardinia. I don't think you've done one yet, is it?
Yeah,
Is it an
no,
option?
we haven't done a continuation fund yet. We're really focused around getting, the companies that we believe should be exited to exit this year, and we have kind of a tail of companies that we are still preparing or are in exit discussions currently. But we believe that continuation funds or continuation vehicles are a great, tool for also our investors, right, to be able to decide whether they prefer the distribution, so DPI, which is important to them, versus staying exposed to the investments that we have that have some leeway with regard to value creation. So we continue to look at assets that we may ship off into a continuation vehicle over time.
And Christian, kind of perhaps not as relevant to you, but do you have any thoughts on that, or perhaps other ways to return capital to your investors? We've seen a bit of a revival in the dividend recap market, which is again at the larger side. But yeah, how are you getting money back?
Well, I think in terms of continuation funds, they have to be done for the right reason. As you were saying, Giovanna, if you really have companies that need more time to develop, that's a good reason to do continuation fund. If you have companies which you cannot exit and you do the continuation fund, then it's more of a defensive. So the question is, why do you really do your continuation fund? Because a transfer, I think, we have one closed-end fund that we are exiting right now. We're transferring some of it to the evergreen. Always this transfer from one fund to another is a very, very difficult issue. And we have had two examples here. We had one example where some investor says, you absolutely need to find an offer, to have comparable value. So you go out, you get offers, and then you get 4 top offers. But if you don't go all the way through, the top offers may pull out and you have great prices, but the prices are not really market relevant because people have just overbid it just to be in the process. And the other side of the investor says, well, get some M&A, companies to do some comparison. And they say, well, it's not really an exit multiple because it's just an evaluation. So it's very difficult, I think, in this continuation fund to transfer a company from one to another because, it's, what is the right valuation? And once you do that type of transfer, there's a lot of questioning, from the sellers and from the buyers.
Yeah, I think someone told me a few weeks ago that only kind of 20-30% of processes where you're trying to raise a continuation fund are actually successful. So like you said, it's still very difficult. I'd like to...
People are suspicious,
Yeah.
When you go see your investors, you have to reassure them. And from them, if they're the same investor, then it's okay. Or if you can buy them out, then you have 2 options. But, typically they're like, why are you doing it? Is there a reason that we haven't seen or something? Even though it may be plain vanilla thing. And they say, well, can you get more? Can you get less? And it's always, it's a difficult discussion with the LP sometimes.
Because I think what we've seen as well is you sell a minority stake, so you get the mark-to-market valuation, and then you can roll your majority stake into a new vehicle as well, which is a endlessly creative industry, as I'm sure many of you in this room are aware. I do want to talk about deployment as well, which I know are both sides of the same coin. You're both working in kind of the small and mid-cap space, but particularly what I've noticed is, people like yourselves are scaling their fund size so they can do bigger deals. But in this environment, we've also seen the large cap funds drop down a little bit more into the mid-cap space because that's where they're finding it easier to deploy. So are you actually seeing more competition when you're trying to acquire at the moment?
So I would say 5 years ago, we saw a lot of that when the market was also a bit more difficult. And we saw some of the larger funds looking into smaller size brackets. I think now with the fundraising becoming much more stringent and LPs being much more focused around lack of style drifts with LPs or GPs, is that they're much more, GPs tend to be much more focused around what is the size bracket they've pitched their LPs to be investing in. So we see less style drift and we see less of the large funds coming into our segment.
Because they still have to hit their minimum equity.
They have to exactly. Yeah. So they have to really show a coherent story for the next time they come to market. And then the real large, cap funds, they've raised so much money in the past 5 years. They need to be very stringent around, the ticket size because they need to deploy large amounts of capital to really deploy their funds.
And Christian, you spoke of family offices as well. So I'm interested, how are you seeing competition? Are they coming to acquire the assets that you're hoping to?
What we have seen, we have been doing that for about 20 years, now over 20 years. The change at least in the Swiss market, and it has become much more professional in terms of M&A. Before you could really acquire quite reasonable sized company directly from the owner. Today, if you get to a certain size of company, there will be an M&A intermediary. And that has changed the market, tremendously, because if you have an M&A, then the dossier gets circulated around and you can be a family office in Germany or somewhere else and still have a pitch at the company. Before, if you didn't have a local presence, local anchorage into the Swiss market was very difficult. So from that perspective, yes, there's more deal which use M&A as before, where there was more property deal flow, and the larger you go, the more M&A you have. And second, because of that, the dossier gets distributed much more widely, and you have more competition from people who could not have had local presence or didn't have local presence, could not access these deals
that will make
before.
A lot of the bankers in this room very happy to hear, I'm sure. Right, I'm going to ignore Germany on this graph, and I know it's still based on exits, but opportunities for deployment in Switzerland. We haven't seen any exits in Austria. How are you seeing deployment opportunities in the Swiss and the Austrian region?
Well, I think the Swiss market is still, a very conservative market. So we see what's difficult is in terms of number of deals, we see about the same number of deals. We just see valuation going higher and higher because of this intermediation having increased. You have more competition, you have more auctions happening, and so you still find a number of good companies. Still find them, but in terms of being affordable, it's becoming more of an issue. And because there's so much dry powder at disposal, some people outside of Switzerland need to pay a certain premium in order to get access to these companies. So we see clearly some kind of valuation going up because there's more competitions happening.
And you, Giovanna, have you acquired in these countries recently?
We acquired 2 companies in Austria in the past 18 months. So I think it's a very interesting and developing market in a sense of that it was much more close to Austrian capital, and now has really opened up. And that has also to do with what you referenced to, situations being marketed more broadly, and becoming accessible to other outside investors. So we think the Austrian market is very interesting. We continue to believe in the Swiss market, and the companies are kind of conceptually thought of as international businesses because the market is so small. It's, as we heard from Florian before, high share of innovation and, profitable setups. They need to be, more digitized than maybe their German peers because employment costs are so much higher here. Energy costs are fine, actually, in Switzerland compared to other regions. So we think that Switzerland will continue to be an exciting market to invest. We haven't invested in the past 18 months.
Maybe just in order for us, since we're a local player and we've been being for a very long time, our job and basically why we try to sell to our investors is basically we try to go directly. Everybody says he has property deal flows, but what we try to do is to either work on deals which can be difficult in terms of intermediation, M&A, like we bought recently a company from a Chinese owner. It took us 18 months to do it, and it was a very complex thing. Went in all directions. It was a very unstable process, but an M&A process could not have lasted for 18 months. Or you go in a very specific industry. We're invested, for example, in a number of watch industry, not producer, but how do you call that? Suppliers to the watch industry. These are very close also environments. You are in there. People, the deal don't get circulated much with M&A boutiques or larger M&A firms. So try to find some kind of we are trying really more to go directly into the source in fields where the intermediation of a deal is more difficult than in others.
And I know there's a whole panel on deal financing later, so I'm not going to go into it in too much detail, but I did this exact same panel at this exact same time last year when kind of we just had the UBS Credit Suisse merger, and I think things have settled a little bit. So I just kind of want your opinion on kind of what impact that has had on the financing available to you. There was a comment on the earlier panel about there's fewer direct lenders operating in this market.
I think Well, the good thing is the situation has stabilized. I think that's a good thing. Interest rates are again going, down. Switzerland is still, in terms of any private debt or something, very difficult because what you get from banks is extremely low. What we have seen the big difference now, what you have only, when we did appeal, for debt, we always had Credit Suisse and UBS competing against another. They had very good conditions. They had a lot of sophistication, which you didn't have in many other banks in Switzerland. So what we see now, the change is, of course, UBS is still doing very well and has the same level of professionalism, but we see other banks, regional banks, cantonal banks come into the market. It's not easy because they don't have, as soon as you get to debt larger than 20 millions, it's a little bit of a new business for them. So it's a big risk taking compared to the balance sheet. They don't have sometimes the same the level of professionalism or the know-how inside. They need to build up on that. And foreign banks, you have some, but it's still nascent. It's really starting. So you see a little bit more competition, but you don't have the hard competition you had really before, where UBS and Credit Suisse were really fighting for the same deals because they had the same competencies and you were really fighting on small things, but they were extremely competitive.
Giovanna?
Yeah, we finance internationally, so for us it doesn't make that much of a difference. But speaking with people in the market, yes, it is actually a disadvantage given how competitive UBS and Credit Suisse both were, and taking one of the international financing partners also out of this, so not only financing but also international financing of your trade business out of the equation is a hit to many companies.
And a final question on deployment before we move on to talking about value creation. Christian, you mentioned earlier, you kind of buy directly from entrepreneurs most of the time. That was on one of the earlier panels as a potential driver of deal activity. Are you seeing more appetite from entrepreneurs at the moment, wanting to bring in external capital? Has that changed, or is it about the same?
No, what has changed is the following: is statistic. The whole philosophy of family-owned businesses has changed. Usually, and that we have seen over the last 20 years changing quite a bit. Usually, if you had your father or your mother was an entrepreneur, you were born in that family, you didn't have much choice of saying, you will take over. And what we really see as a change today is that there is more and more children of entrepreneurs who basically says, I want to do something else, and that has been much more accepted. I think this has opened up. It used to be about 50% of family businesses not being able to finance within the family. I think this is increasing because children says, it's such a sacrifice, I want to do something else, and has been more and more accepted by the old generation, which basically, maybe build up, inherited the business from the family, and then say, well, we will transit out of the family. And what we see in larger businesses, which are above 200, 300 million, then you can really have a family holding on top, and you can really have a family structure stay on and have a totally separated operational management. For smaller ones, if you don't have the family involved still in the company and a true interest in the company on an operational level, it's very difficult.
And Giovanna, do you mostly do primary deals or are you secondary investor?
We do both, primary as well as secondary. But of course, the succession situations are incredibly interesting for us because there you can really bring in the full kind of tool set of value creation and really help kind of take the company to the next level.
Perfect link. Yeah, value creation. What do you do in a succession situation where you bring in, potentially a new management team? I think there's an interesting stat around kind of unemployment in Switzerland is very, very low. Let's talk about that first of all. When you're looking at these valuation creation plans, how do you make sure that you've got the talent in the portfolio?
Yeah, very important question. So I think culture in the firms is super important, and you need to understand what you need to offer to the employees joining the companies. So Switzerland is a very competitive market, of course, with regard to talent. We have a business that does life science engineering for the plants of Roche and Lonza and the like, and there we're able to attract people at a lower kind of annual pay than our competitors, and that is because they get a certain degree of freedom, they get exciting work, and it's a great culture to join. So you know, we can be very technical around how we build the companies, but in the mid-market, you know, people want to work for something that has a meaning. If it's green transformation for kind of the younger generation, or if it's, you know, sustainability in their lifestyle, I think that, you know, that is something that we have to take into consideration.
Christian, I think you had to hire some very expensive engineers. Was it from Portugal?
This is becoming more and more expensive, but I think there's two phases. When you take over a company which has been doing well, I think you have to stay very modest there. You know, what we say is do as well as you have been doing so far for the first 18 to 24 months. Keep your employees, keep your customers, and then, you know, we can see what we can do. You know, just coming in and saying we will do everything differently, even though they have done very well. So our first phase is really, you know, do as well as what you have done so far. Keep your employees, keep your customers, and within the first, you know, then you start developing, you know, what could be the value creation on top of what they have created already. And it's true, then the employment market in Switzerland is a very difficult one. We have seen with 2.5 unemployment, we have seen two major changes over the many years. First is it's not just on executive level, it's really on all engineering level. Going back to the watch industry, the people managing the machines, you know, the décolletage, what you call making the small pieces, it's very hard to find people there. You really have difficulty. The industry is still growing, and it's highly competitive. And what we have seen, the changes there are, you used to use headhunters just for executive people. Now you use headhunters for all levels. For a machine guy who is a, you know, brilliant mechanics, you will use a headhunters. You will use hunters for, you know, different levels. You used to, you know, you're not, and they're specialized headhunters in that industry. They cannot do both. But we used to be just having your headhunters, you know, for executive job, and that has changed because the work market is very difficult. And what we try to do now is, you know, try to hire outside of Switzerland, because if you're missing people, you cannot grow. So then, as you were mentioning, in Portugal, for example, has an extremely well-educated people in the mechanical space. So you may find one. If you find one which is well, then it spreads around, and you can find a second one. So you really need to find alternatives, because not that we don't want to hire Swiss people, but the market is very dry.
And clearly talent is not the only value creation toolbox. There's many things. Buy and build, I'm sure, will be mentioned more times today. We've already had it a few times this morning. But, you know, as we heard earlier, it's not just about having a holdco with a number of different companies operating anymore. You have to actually integrate your buy and build today. I don't know if either of you got significant buy and build plans that you want to talk about as a case study.
I don't know if it's a case study, but I think integration is very important, right? I think, you know, you're quick to buy and build your companies, but if you think around exit, integration becomes much more important. I think we've seen a wave of companies being acquired as not well integrated, and that was fine for a couple of years. But I think the market has become much more sophisticated in looking at these platforms, how well they're integrated, if they're really a platform or just a number of companies put together. And then, you know, we looked at high valuations that, you know, the market has to, you know, adhere to in the end. So when we do buy and build, you know, we need to get the synergies in order to be able to verify or justify the valuations that we need to pay, also for the add-ons that will come cheaper, of course, than our initial investment. But, you know, to have that value creation integration is important.
I think, you know, there's one part is the pressure from the LPs. You know, they love that. So when you go see them, I said, you know, if you tell them, no, we don't do consolidation, they said, how come? You know, I just saw, you know, other people were doing, it's apparently the thing to do. So that's one part where there's a bit of a hype based on that. What has come with us, many times we look at a company in a very, very niche market and very highly profitable, and we say, we need to diversify, and you look for acquisition, and then you look at the plans together, what it could come up to, and you say, no, it's not the right thing, and you go back to the square, you know, back to your drawing board, and you say, no, okay, let's look at other ones. So sometimes making acquisition, it really needs to make sense, and not just for the LP say, yes, we have done some consolidation, we have a consolidation platform of ABC, and because it's a bit of a buzzword. What we do find extremely, because we work, we are not sector specific, we're country specific. So what we find extremely useful is once you are in a sector and you can do due diligence on your competitors with the management, it's a huge advantage because they know the sectors inside out. When you enter into new sectors, it's always, there's the risk linked to that because you need to get familiar with that. You're not as well as familiar as if you own something and then you need to add on something else.
And I'm interested in where else you're driving value creation at the moment, particularly, when we come back to the bottom line, the EBITDA, when you're thinking about multiples dropping generally across the board, you need to kind of match your hoped for kind of exit valuation. You need to grow the EBITDA to kind of counterweight any potential multiple drop. Could have sold for 16 times before, we're now closer to 12. So yeah, how else are you driving value creation in the portfolio?
Yeah. So in the current market, we heard a lot about kind of, the German market being difficult. So I think, growth has become more difficult to obtain organically. So we really focus a lot on margin expansion. So really to make the good companies great, bringing digitization, optimized processes, going for higher quality businesses. And that's really a transformation that, takes 1.5 years, I guess, until you have that through the organization, through the order book, and then kind of grow from that healthy spot. And I think that's what we see for a number of businesses that we invested in.
Digitalization, synergies, et cetera, et cetera.
Exactly,
yeah.
yes.
Christian?
Yeah, for us, one of the, of course, the financial numbers need to improve. That's one thing. But as I was mentioning before, retaining the people is a key thing. And that's exactly where this whole ESG, the good note, a good grade with S is basically being a good, a good employer. And that's where we're improving more and more because people are becoming more and more demanding. Is one thing is the salary. Second is, and that we see really changing with the new generation is they come and say, what is the purpose for me to work in this company? And it sounds like a big buzzword, the purpose, but it's people need to see, why do I get up in the morning? Why do I work? And if they don't identify with the company, they quit. They don't have another jobs because the market in Switzerland is so good that people can quit the job without having the next one. So I don't identify with what they're doing. They're not concerned about certain issues that are of concern for me. And this new generation, I think rightfully so, have strong opinion on that. And I think one of the value creation that we really focus is on making the company attractive, not only financially, but also in terms of an attractive employer, because that's how you keep people.
I have one final topic, which is on kind of relationships with LPs and how that's changing. But before I do that, I just want to see if there's any questions from the audience on what we've talked about so far.
There's a question here that goes back to this issue of primary deal flow. Can you discuss how intermediate the European markets are for transactions? Is proprietary deal flow still a thing?
So proprietary deal flow is still a thing. It's at least something that we really aim for, of course, but it's always been difficult. And I think it cannot be your sole kind of purpose around doing business because they don't happen that often, especially in the mid-market, which is so well banked. And the succession topic that Christian mentioned is much more kind of openly talked about now. So people exchange views around how to get the best owner for their business, how to get the best price, what they look for. So it's less proprietary. It's more intermediated through M&A, but still it is a thing, right? And I guess especially in this market where there may be a price gap between what people would have hoped to sell for kind of 5 years ago and what they may need to settle now, it becomes much more of a kind of intimate dialogue with the next owner. What will they really do with the business and how will they prepare the business and kind of sustain the business for the long term? So that's situations where proprietary dialogue can really come in.
Same for you?
Yeah, I fully agree with what you said. Maybe one difference is you can have semi-proprietary. You have certain companies that says, I don't want to spread my dossier to the
Yeah,
world.
'cause
And,
people like me find it and report it on Mergermarket.
Yes,
So.
exactly. You find
and it's true,
everything.
you said once you do it, in a full scale, I mean, you're basically naked in the market, and the competitors will get it, the competitor will use it against you. So we do have certain companies where they said, okay, we want to keep a close circle of not friends, but a close circle of potential targets. It's still very difficult to keep it confidential, but you may have and then you get selected out people where there's a real, upfront work being done who could be the good fit for the company or the natural fit for the company.
Perfect. Okay. One final topic to close us off then, which is fundraising and relationships with LPs. I think if I had £1 for every time someone told me that DPI is the new IRR, I could probably retire.
Yeah.
You closed the fund 3 billion in January, which is no mean feat in the fundraising environment we've seen over the past kind of 2 years or so. How did you raise that fund? What kinds of conversations was Altor having with LPs?
Yeah, so DPI was one of the important questions. It is, it's not the new IR, but it's a very important measure next to IR. And to be fair, our initial pitch deck didn't even have DPI as a KPI that we presented. So we needed to look it up, what our DPI really was. So that's something that really, evolved over the past 2 years. So we closed our new fund beginning of this year at 3 billion, which is 50% higher than our previous fund at really premium terms. So in the end, it were good discussions, but it's been long and very diligent discussions with our LPs. And we secured existing LPs, and we also won new LPs, and then a combination of higher tickets allowed us to increase our fund. And what's important to our LPs, I guess, was really around kind of being true to our strategy, so that we really could show that when we raised Fund 5, for example, and we committed to a certain fund or investment size that we also stayed true to. We said we're going to expand into DACH, that we did. That allowed us then to increase our ticket or our fund size for Fund 6. And then it's really around kind of what's our raison d'être, why are we relevant? And I guess we're relevant because we invest in companies that grow. We actively work with the companies to drive margin, and that you can see in the numbers historically. And then we were very theme-based across sectors. And one of the themes is all around kind of green transformation, which investors find very interesting. And we have a track record in that. We can show that we have really access to very exciting situations, get in there at an early stage, be it OX2, which we, IPO'd within 1.5 years at a 6x multiple, which built wind parks, which before no one wanted to wind parks. But, once the green transformation really kicked in, that was inevitable, one of the key strategies to invest behind. So I think there we had a very good kind of leeway for our discussions.
We haven't even talked about co-investments, which so central to kind of deployment in terms of bridging, financing, and valuation gaps. But was that a key thing that LPs wanted more access to in this fundraise?
Very interesting that you mentioned it. Yes, that was really strong.
Yeah.
So our key LPs, especially the larger ones, are very strong that they need co-investment opportunities for us to be continued as one of the key kind of GPs that they focus on. So when we now look at situations where we always look as to can we provide some co-investment opportunities for our LPs.
And Christian, obviously coming at from a slightly different angle, but I know you work a lot with the pension funds, and it's no secret that a lot of pension funds have got balance sheet issues of their own a lot of the time. How easy have you found it to kind of call capital, and what's your relationship like with the pension funds at the moment?
Maybe 2 remarks on that. We used to have closed-end fund, and then you go and you have this PowerPoint presentation, you present your...
Why did you move to an evergreen structure?
There was 2 reasons. There was one, pension fund wanted to have, we have only Swiss pension fund as investors, so they are in terms of less probably aggressive than typical institutional investors. So on one side, they wanted to have regular return. So we have a dividend-based fund. That's how we do it. We buy with very little leverage, and we serve them a dividend. And they said that's what we need in order to fulfill our obligations. And on the other side, and that was even more prominent, we saw a lot of entrepreneurs who basically told us, we're fine with Swiss pension funds, long-term, it's a Swiss anchorage and so on, but we don't want to sell our company, in 4 or 5 years. And we had cases, where the guys, we have a case, for example, Bondi. The guy's company is called Bondi. His name is Bondi, and he says, I want to be able to go to the football game in 10 years, or to have a beer in the village without feeling, my company was dislocated or was, passed from one hand to another. So that was the fundamental reason. But when we do the fundraising now, the advantage of an evergreen, and I must say we were not that conscious of that when we launched it, is when you go see at the beginning, you basically have a PowerPoint presentation and you say, that's what we want to do. And then you go and we do first tranche, and then we go for the second tranche, which by finance typically 50 to 70% by the existing investors. They say, we have already 3 companies, do you want to do more of that? And then you go for the third tranche, which we're doing now, and you have 10 companies in the fund. So first, the existing one are comfortable with you because it's exactly the same structures, even though when you have closed-end fund, we had the same team, but you still need to, go through the full due diligence of legal papers and so on. And for the new investors, they basically join in the board and they have already 10 companies which they know they will take advantage of that dividend. So fundraising is still difficult, but when you have it in tranches like that, it's like if you buy into an real estate portfolio, you have already 5 buildings in it, and you said, okay, at least I have 5 in there that I can feel comfortable with. I hope they will do as well after. So that's helping out a lot in the fundraising. And in terms of pension funds, what things has come up very, very strongly over the last few years is volatility. Especially Swiss pension funds, which are our clients, they really want to have less volatility in their portfolio, and because they have difficulties, because of the coverage they have, the numbers changes, it makes everyone uncomfortable. So volatility has become a big issue, having more of an evergreen dividend-based model, less aggressive in terms of return, but more stable in terms of volatility is really helping them.
So you found it quite easy to keep the capital commitments coming in because of the tranches then?
Yes, because, well, let's put it this way. If they're not happy, the existing investors will not invest. So the new one, the first thing they ask, he says, how much are the existing doing? But if you're doing fine, then going back, it's also in terms of decision, it usually stays at a lower decision level within the pension fund. It's just, do we want to do a follow-on in that fund, which stays at a certain level in terms of decision powers. If you do a new fund, it may go to a higher level. You may have to go to the what they call the Anlagekommission, or to the investment committee. And if it's not, it may just stay at the managerial level, or said, okay, we're just doing more of the same, and that's easier.
Okay. We've got 2 minutes left. Any questions from the audience? Any in the room? Okay. I normally try and end things out with an easy question, but I don't have one. So, outlook, by when we sit here next year, what are you hoping to see?
Oh, I'm hoping to see that the market will have picked up. I think the kind of geopolitical environment will have improved. I think that's to all our wishes, and that should have positive impacts on everything we do.
From our perspective, what we have seen is a lot of companies, for example, growing out of Asia over the last, especially China, and now the fact that China is a bit destabilized, there's some questions mark of how stable has been this growth and how sustainable it will be. And it shows also in terms of the U.S. market at the beginning of the year, all the chief financial or chief economic officers of all the banks saying the U.S. is going to be driving the market. Hasn't really been the case today. People have a lot of question marks. So if these two could stabilize a little bit, that could help in terms of planning for next year.
Okay, perfect. Well, thank you very much for my panel. I believe we've got a networking break next, but Catherine is going to tell us more about that. So please give a round of applause to the panel today.
Thank you.
Thank you.